the gates rate, and things will change. Market breadth, of course, in terms of how many up and how many down. Heat map, the Nifty heat map will give you a quick sense of where things lie on the Nifty 50 index. Tata Consumer on one end, Dr. Reddy's there, Hero, Trent, etc. Trent, I think there's a Goldman downgrade as well. But it's kind of evenly split, about 25 up and about 25 lower, roughly, this morning.
You know, on IT, the market's first reaction is, ye dil mange more, not enough. Whether you look at Infosys, whether you look at Coforge, whether you look at Persistent. Let's get all these three stocks up on the screen. Infosys is, flat to slightly negative, despite that good, strong top-line beat. Look at Coforge, 8% constant currency growth, steady margins, good commentary. Market's not, happy enough with it, 3% down. And Persistent has managed 3% constant currency growth. But no, not enough. I mean, you can argue the stocks have already run too much, perhaps. We'll talk about that with our market experts as well. But that's your IT reaction. Market saying we need more. Let's get to what else is working. Tata Consumer, as Manglam said, he went with green on this one. And that's exactly what the stock is doing, 3.5% up. The growth business is working, foods business is working. And it seems that the market is focusing on the top line improvement and not so much on the slight margin compression. Dr. Reddy's is working well. Despite the US business being a little sluggish, at least it's in line with estimates perhaps. And the margin actually on Dr. Reddy's is better than estimates, remember? So 2.5% up on Dr. Reddy's. Tata Motors is up. Eternal, look at the stock go. Eternal, by the way, so far this week has put on 20%. That's the move on Eternal. And fourth straight day of gains continuing. There's IndusInd Bank, JSW Steel, Tata Steel adding a little bit of firepower as well. Overall, consumer is a good space today. Lever, Nestle ahead of numbers. Tata Consumer, I mentioned Eternal. So consumer is a good space. Banks are very flat. HDFC Bank managing about a 0.5% increase. Trent is down on that brokerage note. That so just flagged off 1.5% lower on Trent. And then, like I said, a lot of the big stocks are dragging their feet. Infosys is down 1% now. Reliance is dragging. Bajaj Finance ahead of numbers, a little quiet. TCS is down. SBI is here. So IT and banks are not firing. Consumer is your trade. IT, the debate is wide open. Nifty now down 8 points.
All right. Well, a few stocks that you all haven't mentioned actually from the broader markets. First, let's talk about Tilaknagar Industries. After that 25% rally that we have seen in this month itself, the stock is up another 2.5% and volumes are massive. The street clearly believes that this is a re-rating event because, now they move into another league with regard to revenues, profitability, and also the deal value is fairly digestible at around 4,000 crores. If it was 20-30% higher, maybe the street would not have liked it. So that explains why there is buying in spite of such a big move. Otherwise, there could have been seller news that would play out. So that's one stock. The other one is Sinurres Pharma. We'll have the management later on that will be joining in. And I remember Manglam and me had interviewed him on Chartbusters, the promoter. And they were sounding very optimistic. For the time being, the street likes the numbers as well. Sinurres Pharma, that's up more than 10%. So big move out there on that particular name is what we're seeing. SENORES. Let's get that one up. Jaiswal Nico. Nimesh has been telling us that the ARC has been selling out, gradually reducing stake. Yesterday, they reduced another around 1 crore shares or thereabouts. But the street clearly believes that this is a turnaround candidate. Remember, the ARC had close to 25% stake in the company. Jaiswal Nico is the one that I'm talking about. That's flying away. It's up 10%. Volumes are massive. Yesterday, only 1 crore shares were sold by the ARC. So there'll be a supply overhang. But for the time being, the street is buying into that because just take a look at the move that you're seeing today. After a 20% move, it's up another 10%. Mukund, that's the other one that we're looking at. The reason being that they've sold land of around 650 crores approximately in Thane. Their interest cost last year was around 130 crores approximately. And the net debt appeared like it was around 1,500 crores. So effectively, if all the money is used to retire debt, we'll have to see what the taxation is. Then in fact, they could have been halving their net debt. So I guess that's the reason why that stock is running away. And Bombay Dyeing, again, one of the top volume movers today, that continues up close to around 2.5% or thereabouts.
Just a few other names, right, before we go across to our market master. Force Motors is the number one volume-led gainer. So coming up out of the blue in that sense, big one, 5%. But there is so much else. Blue Jet, these are all in the 2 to 3% range. Blue Jet, Electra, Viatech Vabag, Max Healthcare, PNB Gills is up about 5-6%. Kajaria is up 2%. Thyrocare 5.5% pop this morning. It is very, very vibrant kind of screen right out of the gates that you have on your hands. Coforge and Persistent are the top losers, biggest volume-led losers. But we'll see how they finally end. Natco is down about 1.5. Trent is down 1. It started lower as well. And of course, IEX remains down, limit down at 10%. MGL is down 4%. I don't know if Nigel mentioned, but MGL is down 14.22. We just spoke with Borosil Renewables. That is starting about 2% lower. And DAM Capital is down 7.5%, 232 coming in there as well.
Prashant, on IEX, Hormaz just points out that it's in that freeze, 10% freeze, and there are 4 crore pending sell orders right now on IEX. So let's see. Yeah, that's been the real casualty of the morning, and not sure if it's entirely over just yet. We'll keep an eye out on this and try and touch base with the management as well and see if they have something to share with their stakeholders. But with that, let's move to our market master. Ashwini Agrawal, founder and partner at Demeter Advisors, is with us now. Ashwini, good morning. Great to have you on. So we're in an interesting situation here, right? I think it's earnings, earnings, earnings. That's what the market is squarely focused on, because earnings need to deliver. That's the only critique on India right now. Otherwise, the overall macro narrative remains very positive. Now, what do you make of the market's mental construct? And I want to take today's IT numbers as examples. Infosys actually delivered a beat, not sounding too bearish also. The mid-cap IT companies that have been the market's darlings, Persistent and Coforge, both have delivered. They've not missed at all in the first quarter. But the stock reaction is sharply lower. What does this tell us about the way the market's thinking about earnings and IT in particular?
Good morning, Surabhi. Thanks for having me here. So you're dead right. The reaction of the market to earnings is telling us something that the market is tired. Where earnings are being met, stock prices are not moving. And where earnings are disappointing, stock prices are giving up a lot of gains. In the sense that in some of the disappointments, even in the mid-cap, small-cap space, you find that stocks are down 15%, 20% on disappointing earnings. So, good earnings are not giving you a reward, and bad earnings are being punished. So that tells us that the market overall is a little concerned about valuations. So while there is a hope out there that later in the year, demand conditions will improve, and obviously we are seeing some of that in the consumer names as well, there is some fatigue that's beginning to set in. In IT services in particular, which you highlighted just now, I think valuations are quite expensive. I think, when we look at a PE ratio, a lot of the PE ratio comes from a terminal growth, which is built in. And I think there's a big question mark on that in terms of IT services. So, I haven't really been a huge votary of IT services for nearly 3 years now, and I still don't think that they're cheap enough for me to buy. And I think the market's also starting to kind of, recognize that there are some issues that need to be addressed, and valuations are not cheap.
So where does one put one's money to work? Ashwini, morning.
Morning. This is a great question. I think, on a bottom-up basis, like, again, if you look at the opening remarks that you guys made on some stocks which are up, I think on a bottom-up basis, there are some opportunities which one continues to find. But otherwise, the markets are expensive. I think, financials look fine by and large. I don't think you can make a lot of money from here in financials, but I think over the next couple of quarters, you will see some of the stress in microfinance going away. So, that's one hope that might help, stocks, especially in the NBFC area. Banks overall look fine. I think there will be some compression to NIMs, but hopefully growth will pick up. So that looks a macro area. Consumers, like I mentioned, there are a lot of reports that rural demand is starting to improve. There again, you have to be choosy because some companies which have a very high penetration already, for example, Colgate, and just to clarify, I don't own the stock. They will find it difficult to grow. But I think other areas where you have consumers looking forward to more purchases, there you might see some improvement. So I think it's a mixed bag. I think one has to be more bottom up, and overall one has to be cautious. I think the markets had a huge run, and there's a huge wall of paper ahead of us.
Indeed. Hi, Ashwini. Good morning, and
Morning.
good to see you in. What do you make of these stock market players? You know, some of them had re-rated big time. Exchanges, we'll keep the energy exchange aside for now. But these capital market players, you know, they were going hammer and tongs. Now, volumes are dipping actually. Even yesterday, if I compare it with the previous session, the volumes on the NSE were down by close to 7-8%. And, you know, if at these valuations, maybe participation will start beating off a little bit. Probably. The longer term story is very good. But in the near term, do you think they've run their course? Exchanges, brokerages, wealth management companies, or still do you find value in some of these?
A great question, Nigel. You know, you have to break it up. Okay, so wealth management, asset management are franchise businesses. So, you know, let's say, I'm not saying it'll happen, but let's say the market falls by 20%. You know, the earnings of these companies will fall by well less than that because they continue to see inflows, which is a construct of how financial savings are being deployed in this country. And that's true for wealth management. It's true for asset management companies. On the other hand, exchanges and brokerages, they're directly linked to volumes in the market. And if volumes in the market were to go down, you will have a sell-off in these names. Exchanges are very expensive. Brokerages are not that expensive, but brokerages is a highly cyclical business. And exchanges are expensive, but at the same time, it's a highly moated business. I mean, you're not going to get a third exchange or a fourth exchange, you know, in the country. So to that extent, you know, my sense is that I think the wealth management have and asset management have the best franchise value, followed by the exchanges. Exchanges probably have the best franchise value, but they're expensive. So I would put exchanges next. And third would be brokerages. So I think valuations are expensive and one has to be careful, but that's how I think about it.
So Ashwini, the question is, when you gave some examples, you said financial services, you said maybe
Yes.
you know part of consumer. But again, where? Give us some examples. I mean, if not necessarily a stock idea, you can put the caveat there, but where there is at least some semblance of sustainable growth. Because the problem with the market is growth. So when you say, for instance, if you say consumer or FMCG, if not a Colgate, then what? Because even, let's say, within the QSR space, it's been very, very different. Different companies are doing different things. Westlife yesterday was a good number. Sapphire was weak. So where do you see some semblance of growth within financial services as well? Tier 2 financials showed up various asset quality and credit costs issues. Large banks relatively outperformed. So just slightly more granular on where to put the money in this tough market.
Okay, let me try. Okay, and I don't want to cross any lines here. So in the financial space, in NBFCs, while you're right that the June quarter numbers were not that exciting and credit costs continue to be a bugbear, but I think incrementally the direction of credit losses or incremental stress is coming down. So what you're seeing flowing through the P&L is mostly what has already happened. Now, come December quarter, which is 6 months away, you will start to see a very favorable base effect kick in, and the fact that your incremental NPL generation is coming down, you'll start to see a much better sort of credit cost line for a lot of the NBFCs, especially in the microfinance area. Now, you have to look past the next couple of quarters. That much we have to do. Otherwise, you know, it's very difficult to kind of invest. I mean, you can't invest based on every quarter. So I think that's one area in the NBFC space, in the microfinance space. I think banks are fine. Banks are doing well. There is no major issue, you know, in the banks, and they're not terribly expensive relative to the rest of the market. They're not terribly expensive. So even the frontline banks are not expensive, despite you know, the kind of stellar returns that you've seen in some of the frontline names like ICICI Bank, for example. Now, coming to consumers, I think there one has to be a little more selective. So there are products that people want to consume. So if you look at the consumer today is looking to upgrade his choice of lifestyle. So whether it is cosmetics, whether it is fast food, whether it's instant delivery, whether it's white goods, So there you have to look at on a very bottom-up basis, where do you think surprise is likely, and where do you think valuations are have some room for improvement. It's a very bottom-up market in that space, but and I agree with you. So, for example, in the QSR space, there are some that have done very well and some that are struggling. So that's the bottom-up work that one needs to do. But that's an area where I see at least the consumers, putting more money to work.
Okay. Bottom up, it's a hard work market. It's not an easy market. That's the takeaway from the conversation. Ashwini, got it. Thank you so much for joining in. That's helpful perspective. Good to have you on. By the way, guys, I just want to mention that, in an overall environment where equities are doing really well, Asian markets, etc., trade deal optimism, all of that. Look at this. I mean, our markets turned negative without any major earnings accidents. We haven't woken up to really disastrous earnings or anything like that. Mostly numbers are missing the mark, but the market's moved.
But just look at numbers in the broader markets. You look at a Force Motors. The stock has doubled in 4 months, and the stock is up 5% even right now. This Syneris Pharma, just citing a few examples. The stock has already rallied big time, and now it's up more than 10%. These are stocks that have already rallied, and the market appreciates the numbers, and they're taking it even higher as we speak. So market's clearly distinguishing. They want growth, they want good numbers, they'll reward it. If it's not good, then they're slamming it.
Yeah, but one thing is clear. I mean, just look at the screen. As I think Ashwini started by saying, it's not holding. It's not.
Yes.
It's tired.
It's tired. I think that's a great description. Yeah.
That's what I think it is. Let's talk about the next management which is with us. Coforge is the company that I'm talking about. Absolutely solid performance for the first quarter. 8% CC growth quarter on quarter. And still the stock is down 4.5%. Now, we're of course not going to ask the management about the stock, but we'll try and understand what kind of growth they are looking out for. Sudhir Singh is CEO at Coforge. He's with us now to take some questions. Sudhir, great to have you with us here. Congratulations on a very well executed quarter. I want to just start by a few things. I mean, if you read through commentary across the board, everybody, the general mood amongst analysts says revenues were very good. Margins maybe fell short by a little bit compared to what expectations were. In this quarter, I think there are a few one-offs. Correct me if I'm wrong. I think there is like one-off bonuses, some legal fees, etc. as well. Some 70-80 odd crores of that. Just take us through the quarter.
So the quarter from a performance perspective has been it's been an exceptional quarter. It's been a fantastic, solid quarter. Growth on the growth side, as you said, sequential CC growth has been 8%. The sequential dollar growth for the firm has been 9.6%. Margins, again, the commentary that I just came off from the investor call, we've talked about the fact that the EBIT is going to hit 14% for the current fiscal. And our business, our firm has always seen a sequential increase in EBIT in margins across the quarters. This is quarter one. We've landed at 13.2% despite very strong growth off the back of the ramp up of the Sabre large deal that we talked about. We feel extremely confident that the EBIT number that we will deliver in the current fiscal is going to be 14%. So from our vantage, 5 large deals, a next 12 months signed order book that is almost 47% higher than where it was at the same time last year. EBIT margins profile which should improve very significantly this year. All in all, as you rightly said, a very solid quarter that sets us up very, very well for delivering an exceptional fiscal year 26 as well.
Absolutely.
Sudhir, so we'll put that flash out because the call was this morning at 8:15, 8:30, right? You're saying FY26 EBIT margin will be 14% compared to the just under 13.5% you are right now.
That's right. We delivered 13.2% for the quarter. What we've shared on the investor call is that we expect to deliver 14% for the full year, and that factors in the 13.2% for quarter one.
Okay. Any other numbers? We've been on the air, but any other numbers you've shared on the call, which in terms of forward-looking estimates you'd like to sort of lay out there, apart from the margin number?
I think the other thing that we underline is the fact that the organic growth in CC terms, this is organic, on a sequential basis was almost 6%. We expect organic growth in the current quarter, which is quarter 2, to be equally robust. The third thing that was asked and that was addressed was H2 in turn again should be materially better than H1. So the year from a revenue growth perspective and from a margin improvement perspective seems to be turning out to be an exceptional year.
H2 materially, so I'm just repeating, I mean, this is something you've already shared with your investors in the call, so for the benefit of viewers, 14% EBIT margins by the time FY26 ends and a materially better second half compared to the first half. So sounding as confident as ever, Sudhir. I want to just talk about the BFS vertical, where Q1 there's a minor decline, quarter-on-quarter decline. So what happened? Was it one client off or, one quarter off, or is there any sort of concern on BFS at all?
There's absolutely no concern. BFS is still on a YOY basis growing 32%. So that's very robust growth. This is a quarter blip numbers, and we said this in the investor call, will correct starting the quarter that we're in, which is quarter 2. So banking, insurance, travel, healthcare, retail, all seem to be in a good place, and that's why the YOY growth, the QOQ growth is where it is right now.
Just on the point of 14% EBIT margin, while that's the the numerical outcome that you've put out, just walk us through the levers as well. I mean, is it just deal ramp-ups which will take you there? Is it internal efficiencies? And what's the sense on overall pricing for your services? Is there any legroom at all, or is this not the environment to be talking about price hikes?
We're not baking in any pricing increase in the confirmation that we will deliver 14% EBIT. Almost 70 to 80 bips increase in EBIT is coming from a very structural reason. Our ESOP cost this year is going to be materially lower than our ESOP cost last year. The second reason, of course, is going to be with the significant scale-up that we see ahead of us, the revenue growth. We expect SG&A as a percentage, not in absolute terms, to come down materially. And third, again, because of the significant scale-up that we see, and with offshore continuing to build up at the rate at which it is, offshore revenues, we expect margin accretion to start becoming extremely visible starting Q2 onwards itself.
Hi, Sudhir. Good morning. Good to see you. Ben, we have been talking about that $2 billion annual run rate. You're at around $442 million itself, in terms of a quarterly run rate. By the end of this year, do you think instead of FY27, you get to the $2 billion run rate? That means $500 million on a quarterly run rate. By the end of this year, is that possible?
Getting to a $500 million run rate, let me just take a step back. We don't offer a revenue forecast or revenue guidance. But what we are absolutely clear around is, to the point that you asked me earlier as well, we had said a year back that it will take us fiscal year 27 to hit 2 billion. And the assumption was that somewhere in one of those quarters, we'd hit a $2 billion run rate. As I said last time as well, we'd be very disappointed if it takes us that long to hit 2 billion. We don't want to put a peg in the ground and say that we will necessarily or hit it this year, but we will certainly hit it, at least from a run rate perspective, much earlier than what even we had anticipated, given the fact that we're almost hitting $450 million run rate in this quarter itself.
Okay, all right. You'll be disappointed if you don't get to it in FY27. You said that last time around as well. So we'll watch that. A quick question on the CAPEX. The CAPEX spent in this quarter was around $65 million, for the quarter. And because of that, the FCF went into negative train. Explain to us, what is this CAPEX for? What is it being used for?
It's for an AI data center that we've set up. It is not a dedicated data center for any client. It's a data center that's being used to deliver services to our clients. The CAPEX was at an aggregate level $85 million, out of which $62 million has already been recognized. So our exposure is extremely limited. It was a point-in-time quarter-heavy CAPEX, and it's a CAPEX that will play into what we believe is continued, very robust growth going forward as well.
But will we look forward to more such CAPEX in the coming quarters?
No, you will not see that. We were asked that question in the investor call as well.
Yes.
CAPEX from our vantage is going to be largely directed towards acquisitions. It will not be directed towards data center related operations.
Got that. And just to sort of complete that loop on what you mentioned, acquisitions, anything in the works?
There are quite a few assets that we're considering, but there's nothing that's imminent, Prashant.
We've often and I think you've kind of sort of, in a way, responded to it. The R systems kind of thing, it keeps coming up. Anything, is there anything to it, Sudhir, you can tell us?
No, we just stick to what we put out in the market. We have no plans and no intention of acquiring our systems.
Okay, that's very, very clear. You did mention the margin trajectory, right? 14% for 26. Again, one other thing is, while revenue growth remains best in the industry, margins perhaps are a little lower than some of the peers, etc. Is there a slightly, do you have visibility beyond FY26? Where do you want it to take? What are the levers you have, slightly longer term, beyond this financial year, where margins can head to?
Prashant, this year the only guidance that we gave was a margin guidance, and this is not an EBITDA guidance, this is an EBIT guidance, right? If you look at this quarter results also, 13.2% is the EBIT margin. The EBITDA has already jumped more than 60 bips sequentially this quarter to 17.5%. We believe at 14% we will be right in the middle, possibly above average when it comes to our peer set. 14% is an EBIT margin. Obviously, EBITDA will be materially higher. It's an EBIT margin that we will be very comfortable with, while we then start focusing again on trying to repeat the kind of growth that we saw last year, which was 31.5% growth, and the kind of growth that I just described right now. We've grown 8% CC. Organic growth has been 6% CC. We expect organic growth again in quarter 2 to be extremely robust, more or less on lines with quarter 1. We expect the year to be very strong. So EBIT at 14%. EBITDA obviously much higher, which we believe deliver this year itself, should be the minimum threshold that we operate at going forward.
Sudhir, you continue to sound fairly optimistic. Just give us a word on what you're thinking in terms of wage hikes and hiring as well, and just the growth. Qualitatively, ex of Sabre, what makes you so confident of driving growth in an environment where larger peers are struggling at 0% or sometimes even a decline in the top line?
Well, I am sounding optimistic, and you've always heard me being optimistic, and I trust that you recognize that optimism is always...
And the numbers have come through. You've delivered. Yes, absolutely. The company is, as they say, walk the talk. Absolutely.
Correct. We walk the talk, and we walk the talk for... this is the 9th year of continued, robust, sustained growth. So it isn't a 3-4 quarter, 2 or 3 year growth record. It's a 9th year record. Growth going forward, the confidence stems from what we've built over the years. With AI having come in, there is compression that is happening on the run the enterprise budgets, but there is great openness, there is great willingness right across the world to have conversations around the change the enterprise budget. We have always characterized our operations as carrying an execution intensity that is uniquely our own. We have always talked about hyper-specialized industry experience across very focused industries. And we've talked about being able to use that execution intensity that I talked about and marry it with our deep engineering capabilities to actually deliver real-world impact. That's a track record that takes some time to build. That's a track record that once built cascades. So a lot of that growth, not a lot, I'd say almost all the confidence about the numbers that we're talking about. One comes from our track record of 8 years of walking the talk. 2, it comes from the large deal pipeline that we're looking at. 3, it comes from the fact that as we speak today, our next 12 signed order book is 46.9% higher than where it was at the same time last year. 4, it comes from the fact that despite the bleak macros, we signed 5 large deals in Q1. And we'd be disappointed if we don't sign at least 20 large deals this year compared to 14 last year. Those are the metrics. That's where the confidence comes from.
So at least 20 large deals this year. Got you.
All right, so very quickly, before we let you go, third-party costs constituted close to around 10% of revenues. I think that's a little bit high, right? What explains this? Could you tell us, are you taking up relatively lower margins? Just explain this to us.
No, we're not taking up lower margins. If we were taking up lower margins, our EBITDA would not have jumped sequentially by 61 bips And I
Right.
wouldn't
So
have given
explain
you a
this to
guidance
us,
of
third-party cost.
a very significant jump. It's tied to the data center operations that I spoke about earlier.
Okay, got it.
That's the cost that it stems from.
Got it. Okay, all right. So the market seems to have run a little bit ahead of itself, and that's why we're seeing some profit taking. But you're sounding very optimistic. You'll be disappointed if you don't hit the $2 billion run rate in sometime in FY27, and margins actually will perk up, EBIT margins towards that 14% odd mark. So that's about Coforge. Well, let's move on then to our next management, Bikari Foods. That's on our radar. The company posted actually a decent performance in the first quarter, healthy revenue as well as volume growth. We have with us Mr. Manoj Verma, the COO, and Rishabh Jain, the CFO of Bikari Foods. Hi, gentlemen. Good morning. Thanks a lot for joining in. Well, tell us, what's the volume revenue growth that you're factoring in for the remainder of this year? And also, if you could help us out, what's the margin trajectory?
Good morning. So as we had said earlier, so we'll be in mid-teens. That's the revenue growth we are looking at, say 15-16% kind of a stuff. And volume growth would be a 3% growth. So around 12% would be the volume growth by end of the year.
12% volume growth, right?
Yeah.
All right. And what kind of margin outlook should we work with?
So from margin perspective, you'll see last 2 quarters. So December, the third quarter of last year was tough, where olive oil price was on a very higher side. And we sequentially, if you see quarter, we improved. And this quarter is the highest gross margin what we've seen in the last 7-8 quarters. So at the year end, what we see that we should be at EBITDA of close to 15%, including PLI, of course. So that's the EBITDA margin what we're targeting this year.
Okay. And price increases, what will you work with?
So we've taken some price rise in last 2 quarters, and that's how you see the margin this quarter. And this year, we don't see any major price hikes. So we are comfortable with the prices what we have as of now.
Okay, explain this to us. Why was there a spike in the other expenditures? And what is the targeted ad spends as a percentage of sales?
So from ad spend perspective, so we have as a company budgeted close to 2% of overall revenue. That's the budget what we're taking. And from other lens, basically other expense, so we've done lot of hiring in people, so to drive growth. There are a lot of other professional services what we're taking to drive growth and bringing a lot of tech into the system.
Give us a targets on, Bujra Lalji, I think, as well as Hazelnut. Those are the 2 inorganic growth like you have done. Yeah. How is that shaping up for this year? What kind of contribution will we be looking at from them?
So Hazelnut is doing extremely well. So we had an acquisition in third quarter last year. And the last year, the revenue was close to 60 crore rupees, 55-60. This year, they will be touching 100 crore ARR. So doing very well, this year, they will open close to 10 stores in UP and NCR area. So doing very well. And regarding Gujarat, it's also doing fairly well, focusing more on margins. So this year, there will be some 45-50 crore rupee top line.
So Hazelnut will do 100 crores and Hazelnuts for the year, right?
Yeah. And
margins are improving out there. I think it was
they are into building phase currently, so opening aggressively. So of course they are not EBITDA depriving. So they are good in their premium stores, opening premium stores. So they will be at close to 6 to 8% EBITDA this year. But their potential is to be at 12-13% EBITDA in next 2 years.
Okay, so Hazelnut is at 6 to 8% EBITDA as of now, but you see it scaling up to 12 to around 13%. I think your earlier estimate was that Hazelnut will improve even more to more than mid-teens. That's the trajectory you're looking at. Is that correct?
Yes.
All right. And Bujra Lalji, what will it contribute this year?
So from top line perspective, they will contribute close to 40-45 crore rupees top line. From bottom line, it will be largely break even. That's it.
And exports, could you tell us, it's only a very small part of your business, but on a low base, it's been growing. For this year, how much will it contribute?
So exports has done extremely well, and that's what we always spoke about. So currently, if you look at in quarter 1, it's upwards of 4% is the contribution coming out from our exports business, and much better on the EBITDA contribution standpoint, from the bottom line standpoint.
Okay, all right. So you're already done around 30 crores for the first quarter. For the year, exports will be how much?
Close to 125-130 crore rupees.
125, 130 crores. Got that.
Top two quarters are important because Diwali and festivities. So first 2 quarters.
People are enjoying the chakna. Yeah, got that. All right. What about you mentioned about the PLI benefits. How much of it was realized in the first quarter? Could you quantify the number? And for the year, what are the benefits you look at?
So for the year, we'll book for close to 50 crore rupees, and it's equal in every quarter.
Okay.
So
For 50 crore rupees is what you realize.
Yeah, in a year. So
in a year is what you will realize, right?
Yeah. Yes.
Got it. All right, gentlemen. Thanks a lot for joining in. Wishing you all the best. Keep snacking. We'll hold you all to these numbers. The growth that you've given us, the inorganic growth, scaling up of both those two businesses. And as you look to feed not just the domestic population, globally as well, people want to have a bit of a snack.
Nigel, it's such a study in contrast, right? We had Coforge earlier, data centers, AI, and you have the
Bhujia business here.
Bhujia business, and that's the thing, right? We, as an investor, you don't have to be in fancy areas to make money. You can make money through good businesses anywhere, I recall that famous saying, right? I think it was Buffett who said once, he said, he was asked why he invested in See's Candy. And he said, well, I can't figure out technology, IBM, Microsoft, etc. But I'm sure that technology is not going to change how you chew gum. So similar kind of analogies. But I thought it's interesting. We just spoke with Coforge and then we had the Bhujia business in focus. Well, we'll take a quick commercial break here. We're going to come back in just a bit with Brigade Hotel Ventures. So Nirupa Shankar joins us as their IPO opens up. So a conversation coming up.
Welcome back. Here with us, and of course, the corporate conversations, the earnings conversations continue. But we also have IPO conversations because there's so much action in the primary market. So we are now putting the spotlight on Brigade Hotel Ventures. The IPO has opened out for subscription today. The company is looking to raise about 760 crore rupees, and it's a fresh issue. So let's discuss all the details, the structure, the business, and the prospects with Nirupa Shankar, Managing Director at Brigade Hotel Ventures. Nirupa, great to have you on. Thank you so much for joining in. And, We wish you all the best as you start your public journey. Now, I want to get the model understood correctly first, because you have several properties and then you have tie-ups with a lot of brands like Accor, Intercontinental, Marriott, and you pay these global brands obviously a revenue for the use of the brand name. But you are not an asset-light model. You own the properties, right? In fact, you've actually, part of the issue proceeds will be to pay back promoters for some land that you've bought from promoters. So just can you tell us whether you'll be buying more land from the promoter group? What is the model? And, what about this royalty that you're paying to these global hospitality brands?
Good morning. Thank you so much for having me here. Yes, it is definitely exciting times with the issue opening this morning. With regards to our portfolio, ours is a build and own model. So as builders, we build the hotels and we own the hotels. We give the operations of the hotels to global international top tier 1 operators such as Marriott, Accor and IHG. There are management fees that we pay to them. So it's not really it's kind of a royalty, but we call them management fees. So there's a base management fee and there are incentive fees. So that's a percentage of the top line and a percentage of the gross operating profit. With regards to the land, so currently Brigade Hotel Ventures has about 9 hotels and all our hotels are either owned or leased. In some cases, we buy the land. So we buy the land, and in some cases, we do long leases for the land. Could be a 30-year lease, a 45-year lease, a 99-year lease. As you know, Brigade Enterprises is the parent entity and the major promoter of Brigade Hotel Ventures. And Brigade Enterprises is one of the few builders in the country that does all asset classes. So be it office, residential, hotels, and malls. So in some cases where we do large mixed-use townships, because we were one of the pioneers of mixed-use township concept in the country, in some cases we have hotels as part of these large mixed-use townships. So we do need to sort of move aside or share or buy out the undivided share of the land. So I'm just giving you an example. So suppose we have a 4 million square feet development of all assets. Yeah. And the hospitality composes about 10% of the overall built-up space. We will, Brigade Hotel Ventures will buy the undivided share of the land. Maybe. Yeah.
So just I got the model. Understood that. That was quite helpful. So just on this, Nirupa, two-part question. The management fee that you're giving to the international brands as of FY25, it was about 4.4% of your total revenue. Now, do you have visibility? Will it remain that for the next, 2 years, 3 years? What is the frequency of, or is this an annual fee? How does that cost go? And also in terms of buying more land versus leasing, going forward, will you be looking at more land acquisition, in which case the debt question will become important?
That's right. So the management fees are going to be kind of the same for the years ahead, because the percentage is sort of fixed based on the revenue. So it is going to be 4 to 5% is what our management fees are, as they have been for the last many years of us operating hotels. So there's going to be no change in the management fees. By and large, all the top tier 1 hotel operators have similar models. So our management fees will stay the same. With regards to our strategy when it comes to buying versus leasing, it really depends on the property, right? In some cases, if it's a CBD property where land value is extremely high, we might decide that it's better to lease that property, because hotels as it is are capital intensive assets. You don't want to be spending too much on construction of the property and also on the land. We believe that the success of a hotel is very greatly dependent on the cost of land as well. Land is extremely important component. So in some cases, especially CBD properties or where land is extremely expensive, we prefer to lease and rather than buy, because if we buy, then maybe residential is the better option for better IRRs. But we do have many, I would say currently the portfolio is 50-50. 50% is leased and 50% is bought.
Nirupa, hi, morning. Just a quick word. I mean, have you sort of considered a REIT, creating a REIT kind of structure, putting some of these assets in there, helps you recycle your assets, right? And help sort of raises capital for you and allows you to sort of move on to newer projects, newer properties?
Yeah, I mean, that was definitely, something we pondered on, whether to do a combined REIT with some office assets and hospitality assets, or just do a standalone hotel IPO. I think we decided that, the hospitality sector, has very specific kind of investors, and it's a very different business model. So we decided that it's better to have a hotel company separate, doing its own hotels and growing that business individually, having a focused team and effort, because building a hotel is very different from building an office. But we have, of course, our office portfolio is also growing, so that's something we could have considered. But I think we have taken the call to take the hotel portfolio by itself and grow that company separately.
As a listed entity now, you won't sort of look at within the listed Brigade hotels trying to create a REIT structure down the line or anything, right? For example, we speak with a listed infrastructure company which has done this. Actually, a few have done this now. They're already listed, but down the line, would you consider it?
I don't think that hasn't been our thought process thus far. We do. I'm not sure if you're aware, but with Brigade Enterprises, we've been building a lot of commercial assets, including many of the World Trade Centers. So World Trade Center, Bangalore, Chennai, Kochi, Hyderabad, Trivandrum is coming up next. So we like to place our hotels next to large office parks as well, considering that office parks are the largest demand drivers for hospitality. But thus far, our thought process has been to keep the commercial assets separate and to keep the hospitality assets separate. Once we've, go ahead with this IPO and we become a listed entity, the idea is to just grow the hotel portfolio, within this entity. There's no plans to do a REIT further down the line with regards to hospitality.
All right. Hi, Nirupa. And, since you're going to be listed, we'll be speaking way more often as well. So we look forward to that. Since you're raising this money, I think you'll be virtually debt-free, post repayment of these borrowings. But for the next phase of growth, how do you fund it? If you could give us the broad outlook out there.
Yeah, so you're absolutely right. Once primarily use of the IPO proceeds will go to debt repayment, and then we will practically be institutional debt free. With hotels, they do have a longer construction cycle, around 3 years, and all our hotels are in the next phase of construction. So they're just going to be starting construction. The funds required initially are not as much. In hospitality, most of the funds required are back-ended towards the third year. Initial year is just design development, approvals, initial start of construction, all the civil work. And then second year also typically is most of the civil structure. And then the third year is the fit outs, and that's when you need most of the cash flows. So while we will be institutional debt free, probably for the next 18 months or so, as and when we do require more funds, we will go back to get more institutional debt. The good thing is, because of the parent entity and the great banking relations we have, and our cost of borrowing is one of the lowest in the country for the parent entity in the real estate space, and that is all transferred also to Brigade Hotel Ventures. So our cost of borrowing is around 8.5%, and maybe with the lowering interest rates, that could decrease as well. So cost of borrowing seems to be in check right now. Like I said, we won't require debt immediately, but as and when we do need it, we will sort of enhance our leverage.
And what's the maximum cap in terms of gearing that you'll go to, like a rough debt equity cap that you would definitely have in mind for future expansion?
See, ideally, right now, of course, our debt is on a little bit on the high level when you compare it to equity. But going forward, immediately post this, it'll be 0 to 1.5, so hardly any debt. Probably the maximum we would be okay with is a 2:1. I know in the real estate space, we've spoken about a 1:1, but in hospitality, a slightly higher leverage is okay. So I think we'd be okay with even a 2:1 in the peak construction cycle. But on a regular basis, you'd probably want to limit it to 1.5:1.
Okay, so 1.5:1 at an average as you fund your future expansion. And that expansion includes so much, right? 5 new hotels, 1,000 keys coming up all the way to FY30. I'll end with one small question, because we'll talk more, of course, when you list. But your average room rate, I think, is around 6,500. You know, just yesterday we were talking to Schloss Bangalore. Of course, different offering, different segment. They were talking about ARRs of 20,000 by the end of the year. So for the segments that you operate in, do you see more elbow room for higher ARRs and maybe even better margins?
Yes, I actually watched that interview, so I did see their ARR of 20,000 plus. You know, we have 9 hotels, and our portfolio is spread amongst many tier 2 markets like Mysore, Kochi, GIFT City. There, the rates are sub 5,000, right? But of course, if we are talking about some of our hotels in Bangalore, it could be between 10,000 to even 15,000. So it really depends. You know, I think Pune, Maldives has extremely high ARR. So it really depends where your portfolio is. But I think one thing we can look forward to with the Brigade Hotel Ventures portfolio is that we are coming up with a lot of 5-star deluxe properties. Currently, the portfolio has a 3-star, 2 4-stars, smart business hotels of 5 stars, but nothing in the 5-star deluxe category, which is where my colleague spoke about yesterday. But I think going forward, we are looking to enhance our portfolio in the luxury deluxe segment. So we have a Ritz-Carlton coming up in Kerala. We have a Intercon coming up in Hyderabad. We have a Grand Hyatt coming up in Chennai. So these are all in the 5-star luxury deluxe categories, and that will and then you will see the ARR go up once those hotels come into operations.
I must say, Nirupa, you poured a little bit of cold water on my hopes, because looking at that ARR, I was very sure where I'm going to check in next time in Bengaluru, because Nigel is going for the Schloss properties. I was very happy. You were looking at 6,500, 7,000 ARR. But as she describes, those are not Bangalore city properties. Those are probably outside. But thank you so much for joining in. Good luck to you with the issue, and we look forward to chatting more frequently now.
Likewise.
Thanks for joining in today.
Thank you so much for having me.
All right. That's the hospitality space booming and thriving, and more players coming to the market. With that, I think we need to take a very, very quick break. We'll do that and come back and I think take some trades with Mitesh in just a bit.
Okay, welcome back. Just take a quick look at the market, down 60 points, 25,160. And Coforge is cracking big time. It's down 8% now. That's the stock 1,710 rupees, coming under severe amount of pressure. We'll sort of talk more about this as we sort of go along. But for now, let's get Mitesh in with quick thoughts on what he'd want you to do in terms of trades. Mitesh, what do you have?
So, Prashant, I think On the stock side, I have one buy and one sell recommendation. SRF, after a good correction, is turning positive again. So this is a buy trade. Recommend a stop below levels of 31.80 here and a target of around 33.60. And the other stock is Astral. That's something which has turned negative on the hourly, 2-hourly charts. So a sell recommendation with a stop just above levels of today's high, which is 1489. So 1490, 1491 could be a good stop here. And look for targets in the range of 1420 to about 14.
Okay, all right. Thanks a lot for that, Mitesh. Well, I'm focusing on a few stocks that are moving around. Let's talk about Mukund. The stock is higher in trade. Why? Because they had a parcel of land that they have sold. They've realized roughly around 38 crores per acre because it was a large land parcel, and they've realized close to around 670 crores or thereabouts. So they've sold their land in Thane. The street was awaiting this trigger, and that's why, in fact, the stock is celebrating it. If you do just, the rough calculation, 673 crores, and they've sold around 17 acres, 17.77 acres. Rough calculation comes to around 38 crores per acre. This is good for them, and they've already received 110 crores. Why is it good? Last year, their interest cost was around 130 crores approximately. And if you look at the net debt number, that's the long as well as the short term put it together, will be roughly around 1,500 crores. So effectively, they can cut their debt by half if all these proceeds are used to bring down the debt. That explains why the stock is higher in today's trading session, moving higher on very, very large volumes. The stock actually had corrected from around that 190 odd mark once the Bajaj family took over. There were a lot of hopes of a turnaround. Then it corrected to around 120. But as you can see in the last 1 month or so, it's pulled back from the lows. And today, moving on very large volumes. Sri likes this development. For the time being, we slip into a short break. On the other side, we have our special segment, Indianomics. How much stake can foreign entities own in Indian banks? And should the rules change? Lata discusses this and more with two former RBI deputy governors, Anand Sinha and S.S. Mundra, and banking expert Harshvardhan of Bain Capital. You don't want to miss this conversation.
Welcome to Indianomics. Foreign banks like Sumitomo Bank of Japan and NBD of Emirates want to own larger stakes in Indian banks. But the laws are not exactly welcoming because the Banking Regulation Act says no entity, Indian or foreign, can have more than 26% voting rights in a private bank. Now, it is tough for a Sumitomo Bank to convince their shareholders back home that they have 50% stake in, say, a Yes Bank, but only 26% voting rights. That explains why even the IDBI sale is taking so long. Separately, in PSU banks, FPIs, now I'm not talking foreign banks, FPIs, foreign funds, can own only 20%. But there is no such a cap for private banks. FPIs can own up to 50, 74%. So the weightage of PSU banks like SBI and BOB in, say, the MSCI and the FTSE Emerging Market Index suffers. Does this cap need to go? For both these very important questions, I'm joined by former policymakers, actually, two former Reserve Bank deputy governors, Mr. Anand Sinha and Mr. S.S. Mundra. I'm also joined by a banking expert, Harshvardhan, senior advisor at Bain & Company. Gentlemen, thank you very much indeed for your time. Mr. Sinha, let me start with the more easy rule first. This 20% cap for FPIs in PSU banks, is that even needed right now? Since, you know, can that rule be just dropped?
Well, you see, we have to see why there is a cap. Now, government has to have a minimum of 51% shareholding in a public sector banks. So for other shareholders, you have 49% available. Now, the cap of 20% for foreign investors means that in the non-government space, they can go up to 40% of shares. Balance 60% is there for the domestic investors. So this can be modulated. I mean, one can even think of a very market-based situation where you remove the cap altogether and live with the possibility that the entire 49% is taken over by foreign investors. So that is one scenario which can be thought of over a period of time. But I would say that there should be, you can tilt the balance in favor of foreign investors to a certain extent, but not crowd out the domestic investors. That is how I would look at it.
Okay.
So maybe you raise 20 to 25 to 30, but I won't think we are prepared to create a situation where domestic investors can be completely crowded out.
Okay. No, Mr. Mundra, let us look at it more from a stock market angle. I mean, practically, do you think any foreign fund or even set of funds will want 49% when you know that the government of India is going to call the tune in these PSU banks? Why should we even assume that a bunch of foreign funds will cartelize and try to buy 49%? The problem is, because of this rule, and I'll put up a table for you, which IIFL Alternate Desk has put out. Because of this, the weightage of SBI and BOB is less. It's a qualitative rule which lessens their weight in the MSCI, and they don't get enough foreign funds, even from passive funds. So, Mr. Mundra, your take. Can this rule be dropped? It's not serving any purpose.
Okay. Lata, there are, I think, to my mind, there are 2-3 angles to it. One, as Mr. Sinha has rightly pointed out, from any, nation's perspective, government's perspective, it would not be a great idea to completely crowd out the domestic investors. They have to have a say and pie in the public sector banking space. That is one point. The second point is the point which you mentioned, but tell me today, despite the government ownership, despite the government calling the shot, whether public bank performance is found wanting in any way. In fact, if you look at the recent history, I think they are performing better than their counterparts in the private sector banks. So that's the second point. The third point is, yes, from the perspective of the market capitalization of the bank, it will be a booster if the foreign investors can have a larger share, and the ultimately beneficiary for that would be the government. But looking to the recent history and where we are today, I don't think government is in a hurry to cash out on that portion. So beyond the economics and the logic of it, I think there is a political part to it, there is a sentimental part to it, and ultimately, even if you want to do away with 20%, it would need an amendment in the Banking Regulation Act. So while the argument is tilted on both sides, I agree there is a room. Room is not that from 20% you go up to the 49%. There could be a midway. But yes, that would need a political preparedness. That is how I look at it.
Okay, two things, sir. I am not accusing banks of performance at all. But what I am saying is the presence of this cap, it is a qualitative rule in MSCI. Wherever there are such caps, since there can be a future restriction on the floating stock, the MSCI automatically gives it a lower weight. I will put up that table again for the benefit of our viewers. See, 20% is allowed. The maximum is 11% stake that foreigners have in SBI. In BOB, it is like some 5%. In PNB and other banks, it is in low single digits. It's not as if people are crowding even to the 20%. They will come when they feel like. So the point is, SBI, for instance, could have easily got $1.4 billion more of passive funds. They raised a QIP now. You know, instead of raising it at probably 800 rupees, they could have raised it at 900 rupees. If this cap was not there. So, Mr. Harshvardhan, from a purely market point of view, since no purpose seems to be solved by this existence, can't we quietly drop it?
Lata, totally agree with you. This is a vestige of the nationalization era. It's old, more than 50 years old. And here there are several reasons, Lata. One is, if you look at a long-term view, you know, we say that our current banking credit to GDP hovers around mid-50s. And we want to take it to 130% as the part of that overall Viksit Bharat. I mean, our banking capital have to go to 50 trillion plus. If you just back of the envelope, where is this capital going to come from? And a lot of that will have to go into PSU banks. But otherwise, it creates a fiscal drag on the government. Every time these banks have to raise, and even if there is no NPA episode, even if the normal course of business, they have to raise capital, the government has to put out 70, 80%, whatever stake it holds. So I think we need access to deeper capital pools for the banking sector as a whole. And remember, this 26% threshold comes out of Companies Act because after that you become significant minority. Public sector banks are not under Companies Act. Government is hugely privileged. It has 51% ownership, has entire governance with it. So I don't know where the hesitancy comes. My firm view is that we should allow it to go to 49%. Government will continue to own 51%. And look, I don't buy this crowding out argument. Look at the sectors where 100% is allowed. The Nifty ownership of foreigners has gone down. So I don't see that to be an issue that should come in the way of allowing access of capital. And remember, now our regulatory capacity has dramatically increased. There are many instruments RBI has to deal with any governance issues that might come up with higher ownership.
Yeah.
By the way, even at 49, that 5%, 10% single ownership threshold will apply.
Yes.
It's not as if somebody is going to run away with 30% stake. And in case of PSU Bank, the voting cap is 1%, not 26%. Okay. So I'm saying, given all of this, I just don't know why the hesitancy should be.
Okay. Well, fair point. Actually, I'm in agreement with Mr. Mundra that the government has that much political capital. And this may be the smallest reason why they have to expend it. They may want to expend it for other reasons. And the other point being that, you know, we may say that if you raise the cap, we will get more capital. Precisely when you want the capital, when we were going through the asset quality review, that is when the FIIs will not come. They will come when you least want them, you know, when anyway the capital markets are friendly. But that's another point. I would very strongly vote with Mr. Harshvardhan on the issue that this is a vestige of a previous era and can be quietly dropped without making too much noise. But Mr. Sinha, you know, the more important question is not really public sector banks. This became important only because of SBI's QIP. But otherwise, it is in the private sector banks that one single foreign bank, and now I want to make this very clear to our viewers, we are not talking FPIs as a category, we are talking about one single private bank wanting to own, foreign bank wanting to own a larger stake in an Indian private sector bank. Mr. Sinha, do you think the time has come to remove this 26% cap on voting rights if it is a widely held institution? You don't remove it for, you know, a single individual, a promoter entity. But if it is a Citibank, if it is a Sumitomo Bank, they're anyway widely held. Should we start this debate at least that this 26% cap needs to go?
So let me make two basic points and then I'll come to this question. The reason why there is a cap on voting rights, which alternately you could do by putting a cap on shareholding and having a one-to-one correspondence between voting rights and shareholding, is from the perspective that we in India have so far stuck to the point that the ownership and control should be diversified. It should not be too much concentrated in one entity. So that is one. The second thing is that it is an accepted principle and it is documented in RBI circulars that we do not want the Indian banking system to be dominated by the foreign banking system. And the current metric is about 20% of capital and reserves can be held by the WOS and branches. So this is the scenario. Now, the second one has come out of the experience of global financial crisis. And this is not something which only India practices, which others also practice. Now, coming to your specific question, you see, there was a time when there was a cap of 10% for promoters and for everybody else. They were all on par, and even the voting right was capped at 10%. Then it was raised to 15% for promoters. That is, the idea was to create a better status for the promoter compared to non-promoters. And now it has been raised even to 26%. So that is the idea. But there could be situations where you may have to allow more than 26% shareholding. Supposing a bank is in distress and a foreign bank wants to take over. So that is a situation which is a perfect situation for allowing more than 26% shareholding, but the cap on voting remains at 26% for the reasons which I explained.
Yes.
I would agree that the cap should be operated on shareholding limits, rather than through a disconnect between voting power and shareholding. Now look at subsidiary, a foreign bank subsidiary. Now there is no equivalent for Indian banks because in India, a bank cannot have a banking subsidiary. So this is something very exclusive to foreign banks.
Yeah.
Now foreign banks, we allow them 100% ownership. Now here, the voting limit has no meaning at all. No meaning. It is, in a way, you can say it is 100% voting rights.
So,
now, the moment...
Mr. Sinha, actually, we are running out of time. We have to take a commercial break. We will continue the conversation after the break. But I suspect on this issue as well, Mr. Mundra's former point that political capital of the government is limited, and will they use it to remove the voting rights cap of 26%, that too to help a foreign bank, looks a very remote possibility. But it is worth debating whether we have to remove that cap because India is in a growth path and we will need foreign capital sooner or later. Those questions after the break. Back in a minute. Bazaar viewers, you can catch the full show after market hours on Indianomics.